Us, this morning, we've been trying to stay on top of all that's happening and the fact that there's continuing uncertainty. I mean, we heard from the Prime Minister, still no clarity as to any kind of fiscal plan coming in, and as expected, an extension of the lockdown. Mukul, does it change anything? Because, to a large extent, we knew that this extension was coming.
Actually, on the margin, there's quite a bit of change, because what happens is, if you want to use a thumb rule, each week of lockdown, full lockdown, is roughly 1% of GDP. That means 50 to 60% of the country's economic activity is shut down. So now, if you do the math, we are probably going to be negative GDP for this year.
And in
fact, that is okay.
Yeah. In fact, the IMF has come out with some really, really bad predictions for global recession and depression.
I saw the WEO outlook for India. It was still positive, but post yesterday's announcement, I think it's going to be negative now for the year. Now, per se, since it's a one-time impact, if you look at how the earnings shape out and how revenue shape out, especially for companies that are non-levered, it's not going to make as much of a difference. But it has other implications for the economy. So earlier we were expecting that the fiscal deficit goes to 5.7%.
Yeah.
An additional funding requirement of roughly 5 lakh crores from markets. This goes up substantially now. And this is where, the focus is going to shift to for the government. How do you manage the borrowing program of the government while keeping the money market stable? And, this is something to really watch out for. And one reason why we're cautious on NBFCs in this environment, any NBFC actually, because through the year we expect a fair amount of volatility, at least in the money market. So it has implications. I mean, overall, it's still a one-time event. Once India gets it under control, you'll expect a slightly better outcome, but that seems a little far away right now.
Saurabh, I was reading a comment somewhere this morning saying, is this government going to come out with a plan once the lockdown is over? While, the calls for it grow louder, and the concern that we haven't seen anything on that front. I know that you've been saying this is an opportunity, but in terms of the collateral damage and the long-lasting damage that we're going to see, are you concerned about the fact that we haven't heard from the government on a stimulus?
I think to be fair, they've done what they can. So 1% of GDP stimulus from the finance minister. The RBI stimulus a couple of weeks ago is somewhere around 4% of GDP. When we speak to banks, it's clear that the RBI has flooded the system with liquidity. So you speak to the top banks, HDFC, Kotak, Axis, ICICI, it's clear they have buckets of money. And I think that will be the theme of the next 6 months. For strong companies, this is going to be, unfortunately, whether we like it or not, but strong companies, this is going to be an incredible opportunity for them to consolidate market share positions. So if you see the announcements that are coming through, Berger Paints helping distributors, Titan helping its franchisees. I'm hearing that we're going to hear Jockey also, Page Industries also has plans to help its channel. So companies which have strong balance sheets, as Mukul said, companies with sort of strong balance sheet, great cash flows, are going to use this to squeeze their competitors out. We saw something similar after demonetization, something similar after GST, and I think a very similar dynamic is playing out. And even in the case of the RBI's monetary stimulus, the TLTRO program, the repo program, it's very clear that the top 4 or 5 banks and the top 3 or 4 NBFCs are flooded with liquidity, and the rest of the system.
Just to butt in there, sort of, yesterday Deepak Parekh was saying that RBI will still need some kind of a one-time solution because transmission is just not happening. That's
So I think what Deepak Parekh has said, and I think several NBFCs are saying, is that the elite NBFCs and the elite banks, they are flush with capital. Because just thinking about it logically, if I am, say, HDFC Bank or Kotak Bank, I will borrow from the RBI using this new the program RBI launched 2 weeks ago, and I will lend to an elite NBFC like, say, Bajaj Finance, right? And I'm locking in a 200, 300 bip spread. Why will I go down the curve to a second rung, third rung NBFC. So what's clear is that the weaker NBFCs do need support. And my reckoning is in the next 20 days, we will get a program for the second rung, third rung NBFCs, because as aggressive as the RBI governor's program was 2 weeks ago, it's helping the elite, but not the second, third rung. And I think there will be something that will have to be expedited there. So I think the government has done what it can. I think the best way to look at this is see how financial markets across the world are reacting. Whichever country debts tail off, the stock market rallies. Whether it's Korea, whether it's Philippines, whether it's the United States, as soon as debts tail off, as soon as cases tail off, the market rallies, right? So globally cases are coming off. In India, the cases aren't yet coming off. We're still getting a bit of a trend upwards in the cases. But if the cases come off over the next 2-3 weeks, I think we will get buckets of foreign money pouring into India, much like we've seen into Korea, into Philippines, and into the American market itself.
Sure. Mukul, just taking away from the point on NBFCs as well as private banks, would you say that, if the government continues to extend foreclosures, extend forbearances, tactically, is it time now to rethink how you would approach private banks, or for that matter, even consumer finance companies? Because retail delinquencies perhaps is going to be the new reality post-COVID.
So, what you're saying is absolutely correct. Retail delinquency, we'll see how it plays out, and it's definitely a concern. Having said that, one has to remember two things. One is going into this crisis, the penetration of credit rating agencies in India really picked up. More than the penetration, it's the awareness of credit. So going into the crisis, retail credit in India was actually quite well behaved. I'll just give you anecdotal sort of information that, we did an IPO for an international MFI. They're operating in, I think, 12 different emerging markets 2 years back in London. One recurring message from that NBFC was that the credit behavior or retail behavior of credit in India is one of the best in the world. And that's partly because of the, what has happened with the structure of retail credit in India. The second point is retail credit in India itself is very underpenetrated. So what you may see actually coming out of it, that retail credit doesn't blow up the same way it did in 2008. So expectations may be sort of, a little bit, better off than where we stand at present. Having said that, I just want to nuance the point you made on NBFCs versus banks. Banks in this environment, as Saurabh was also saying, they're flush with liquidity. They're even lowering their cost of deposit. So margin-wise on the banks, there should not be an issue. It's going to be more people will watch out how the asset quality plays out. Part of it will be retail.
Okay, gearing up now for the pre-open race. The SGX Nifty, remember, while we were away on holiday,